All right, let's just jump right in. Today in this explainer, we're putting Amentum, that ticker symbol AMTM, through the absolute ultimate stress test. We're cutting through the noise, ignoring the hype, and relying entirely on hard, structured data to see exactly what is going on under the hood of this company.
So you're probably wondering, is Amentum the market's next big buy? Well, to answer that burning question, we're going to run the stock through a highly strict, multi-layered analytical framework. We don't do gut feelings here. To give you the short answer right up front, Amentum is not a buy right now based on valuation and macro risk signals. It is overvalued, momentum is weak, and our macro rule set absolutely does not confirm a safe entry. But to really understand why, we need to look at the data.
Here is the gauntlet we are running today. 1. The target, Amentum. 2. The valuation and momentum test. 3. Technical signals and RSI. 4. The macro risk overlay. 5. The fundamental growth outlook. And finally, number 6, our final verdict. Let's get to it. Okay, starting off with section 1, getting a baseline profile on our target, Amentum. Amentum is currently trading around $26, which puts it in the lower middle of its 52-week range. It has a market cap of about $6.4 billion, so it's a pretty sizable player in the government services and defense sector. But right out of the gate, we're seeing completely normal volume. The price is literally just treading water right in the middle of where it's been all year. There's zero aggressive buying volume pushing it higher. It's just kind of lingering. Let's move on to section 2 and test out the valuation and momentum. Now, I want you to pay attention to this massive number, 65.1. That is Amentum's current price-to-earnings ratio, meaning you are paying $65 for every single dollar of this company's earnings. For a high-flying, hypergrowth tech startup, sure, maybe that's normal. But remember, Amentum is a government services contractor. To put that into perspective, the normal PE range for the defense sector is usually between 15 and 25. So a PE of 65, that is wildly overvalued. We are looking at a huge premium here, and honestly, there is just no recent earnings acceleration to justify paying it. Based on valuation alone, this is a clear not yet, unless we see some truly explosive growth. All right, section 3, technical signals and RSI. Let's do a momentum check. We use the Relative Strength Index, or RSI, to gauge momentum. And because the price action has been showing really low volatility and sideways trading, the RSI is stuck right in the mud, totally neutral, hovering in that 45 to 55 range. Simply put, there is absolutely no buy signal here. For our system to trigger, we need an oversold RSI mixed with positive macro conditions. The technicals right now are practically asleep. Let's step back and look at the bigger picture in section 4, the macro risk overlay. Before we dive into the data, let's quickly define a few key terms that act as our ultimate security checkpoints. First, HYAS measures credit risk in high-yield corporate bonds. Basically, it tells us how nervous lenders are. Second, the MOVE index is a lot like the VIX, but it measures bond market volatility. And finally, the RRP, or reverse repo program, measures how liquidity is flowing through the whole financial system. For a safe entry, we really need these to be calm. But right now, the macro environment is flashing bright red warning lights. The VIX and VVIX are elevated. The MOVE index is showing serious stress in bonds. The TED spread isn't improving at all, which means banks are actually hesitant to lend to each other. And that HYOAS we just talked about, it is definitely not trending down. We have absolutely zero bullish confirmation from the credit markets. It's a really tough crowd out there right now. Now let's talk about liquidity flows, because this builds a massive bearish case. Step 1, the RRP is rising, so cash is getting locked up. Step 2, the Treasury General account isn't falling, meaning no fresh government liquidity is hitting the market. Step 3, the Fed's balance sheet is actively contracting through quantitative tightening. Basically, liquidity is the lifeblood of stock momentum, and right now, the system is starving. There's just zero capital injection available to propel a heavily overvalued stock like AMTM. On top of all that, global capital flows simply aren't looking at AMTM's sector right now. The money that is moving through the system is heavily concentrated in mega-cap tech, not defense or government services. So demand is weak. If you buy in now, you're essentially swimming against the current of global capital. Okay, section 5, fundamental growth outlook. Let's check the underlying business health. Can the fundamentals save the day? Unfortunately, no. When you pair a crazy high PE ratio of 65 with slow revenue growth, naturally thin margins, and literally no major upcoming catalysts, you get an incredibly poor risk to reward scenario. The business just isn't generating the fundamental firepower you'd need to override the terrible macro and technical setup we just went through.
Which brings us to section 6, the final verdict. Let's look at the scorecard.
This summary table is pretty devastating, and it shows exactly why AMTM is a firm no. It fails almost every single metric. Valuation, overvalued. RSI, totally neutral. Liquidity, tightening. Volatility, elevated. Credit spreads, not falling. Capital flows, looking elsewhere. Momentum, weak. When you lay the raw data out like this, the picture is crystal clear. There is zero ambiguity. Investing is all about asymmetric risk and reward. You want multiple overlapping data points confirming your decision before you ever risk your hard-earned capital. Today, for Amentum, none of those confirmations are present. The framework did exactly what it was designed to do. It kept us out of a bad setup. So, with AMTM completely failing the test today, what area of the market should our rigorous system scan next? Should we run this framework against a full big tech watch list? Do we strictly target new IPOs? Or do we just cast a massive net to find the objective best buy right now? Think about it and let us know what you want put through the gauntlet next. Keep learning, keep relying on the data, and we'll see you in the next explainer.